class today. This is the first CE credited class for Scott Wartman. So all of the property managers that are on this time will certainly get a credit. And we appreciate that, Scott, getting that all updated. My name is Peggy West. I'm with Capital Lighting now. And Capital Lighting is been in business about 50 years, and we have several locations in the Palm Beach and going into the Broward area. I'm just introducing myself, and then I'm going to turn it over to introducing the sponsors for today. Let's start with Rudy Martin. He's Vice President and our moderator today from Munyon Painting. Rudy, would you like to say a few words?
Thank you, Peggy. My name is Rudy Martin. I'm the VP of Business Development and partner here at Munyon Restoration, Painting, Waterproofing. It's a long name. We just call ourselves Munyon. We're one of the premier painting restoration companies in South Florida. We're celebrating our 70th year. I haven't been here the full 70 years, although I look like it with the gray hairs and the beard. I'm going to be driving the bus today. Scott and Nicole and Bill have tons of information for you, and I'm going to be politely interrupting them with questions. So if you have any questions, you have a Q&A button on the bottom of your screen. Go ahead and press that and ask away. I'll gather those questions, and then I'll pass them on to Scott, Nicole, and Bill. Thank you for your time, and thank you for joining us. I guess now we'll turn it over to Brian because he's next on my screen.
Okay, looks like Brian is not on yet, so I would like to.
No, I'm here. I'm here. It just took me a minute to unmute. Good morning, everybody. Brian Van Dam. I'm Business Development Manager with Yellowstone Landscape. I'm very proud to be part of the presentation today and sponsor. We provide landscape maintenance, landscape design and install, irrigation maintenance, install and repairs, lawn and ornamental pest management, fertilization for turf plants and palms. We can do mulch, we can do your flower changeouts, tree trimming, palm trimming, tree removal, and hurricane planning, both pre and post-storm safety plans. So if you're in need of commercial landscape services for your property or HOA, please think of me and let me know if I can help in any way.
Thank you, Brian. I want to introduce a couple of people here that are the winds beneath our wings here for all of my presentations I've been doing by Zoom from Vinteum software. Today we have Yasmin Johannes and Layla Scola, and the business development representative is also on today. So I wanted to see, would you three say a few words?
Yeah,
Layla?
absolutely. I'll be talking on behalf of Vinteum.
Okay,
Layla
great.
and Yaz. They will not be joining us at the moment, but yes, my name is Frank, and I am the business development representative at Vinteum Software. We make websites and communication portals for HOAs, condominiums, and property management companies. We have a 5-channel approach to communication that is paired with a variety of management tools, including handling service requests, document storage, and online meetings, and so many more tools that we do offer as well. If you are looking to more effectively manage and improve your overall communication with board members and residents, please feel free to reach out to us. We'd be happy to set you up. You can find us on our website at vinteum.io or email me directly at frank@vinteum.io. Thank you.
Thanks, Frank. I appreciate that.
Absolutely.
I'm sorry I said Ken.
Oh, that is okay. No worries.
I wanted to also introduce Beth Garcia Swopo from Brown & Brown Insurance. Beth?
Hi, good morning, everyone, or good afternoon now. My name is Beth Garcia Sopa. I'm with Brown & Brown Insurance. I'm based out of the Fort Lauderdale office. However, I do live in Martin County. So when I say I literally travel the whole south of Florida, I do on a daily basis. We specialize in condominiums within our office, HOAs, POAs. The great thing about Brown & Brown is we are all over the state. So my territory extends all over the state as well as across the country. We're in 38 states currently. We have over 10,000 employees. At Brown & Brown, we do have a retail division and a wholesale division, and where that benefits our associations is we have a lot of premier appointments, direct carrier appointments. When we have to go to the ENS market for a property, as you know, there's not many standard carriers that are writing property in the state. We also own 3 wholesale divisions, so we're able to get the best rates, best service, best package available for our clients. and that's in the property world, liability, cyber, umbrella. With the rates increasing, as we have seen, what's happening in the insurance marketplace is something like we haven't seen in years. I'm suggesting to all of my clients to get ahead of it. Any new prospects, we're looking out to the marketplace about 120 to 150 days prior to, as opposed to 60 and 90 days, which was typically the norm in the past. So if there's anyone I can help that's on this call, I'll have my contact information on the chat. Please feel free to reach out to me.
Great. Thank you, Beth.
You're welcome.
Sure. Okay, and I just want to mention that I will continue to network and work with the former employer of mine from Pure Clean. I'd like to introduce the franchise owner, Daniel Castro. Daniel, you want to say a few words about Pure Clean? Is he on?
I don't think he's on.
I don't see him on, Peggy.
He's not on? Okay. Okay. All right. Well, as you know, I've been campaigning for some business for Pure Clean for the past year, and I made this move here recently, and I'll just do a brief introduction about Pure Clean being in business about 30 years. They are water, fire, mold, damage restoration company, and very good resource here locally with about 30 different locations all over the state, several in South Florida because the corporate office is based out of Tamarack. So if you need anything, Daniel's information will be sent to you following this call. With that, I'm going to again reintroduce the class. It is association governances, points, and also we have legislative update by Scott Wartman today, and along with him is a caveat here for financial tips by Nicole Johnson Pendergrass and Bill Kilgallen. So with that, I'm going to let Nicole, if you'd like to introduce you and Bill.
Sure. Good afternoon, everybody. I'm Nicole Johnson Pendergrass with Hafer Company. We're a full service CPA firm. I'm sure a lot of you are busy right now because Friday is the deadline for audits. So hopefully everybody has their postcards out and everything's finished and ready to go. We're down to the wire. We specialize and concentrate in the area of HOAs, condominiums, developer turnovers. We do about 700 associations in the state of Florida that we do a lot of consulting. We open up to anything budgeting, consulting, PPP money, taxes, which I'll have Bill discuss. But today's a great class. Scott has a lot of great information. He's a great speaker. So I'm looking forward to the class. Thank you, everybody. Bill?
Hey, thanks. Good afternoon, Nicole. Bill Kilgallen, and I'm on the tax side of Hafer, and we do quite a few associations, as Nicole mentioned, their tax work. And so what we're seeing is a trend that everyone's getting their financials done and their tax returns done earlier than normal. So enjoy the class.
Okay. Well, thank you. And with that, I'm going to turn this over to our guest, our featured speaker, Scott Wartman from SJW Law Group. Scott, thank you so much for today.
Thanks, Peggy, and thanks, Rudy, for moderating, and all of our sponsors and everyone for joining. Again, my name is Scott Wartman. I'm an attorney practicing in Wellington, Florida. I've been practicing law for 28 years, and I specialize in representing condominium associations, homeowner associations, and co-ops, as well as property owners associations, master associations. I'm Florida Bar Board certified in the area of condominium and planned development law, as well as Florida Bar Board certified in the area of real estate law. There's approximately 30 attorneys in the state of Florida with those two board certifications. If you'd like to contact me after today's course, if you have a follow-up question, feel free to reach me at 561-340-4555, and my email is Scott, S-C-O-T-T, at sjwlawgroup.com. My firm represents approximately 80 communities, and I'd be happy to assist you, property managers, with your questions or your community's issues. So today's course, as it's described, really has two parts to it. The legislative update, new laws being considered and or already passed in Tallahassee that impact and affect condominium associations, homeowners associations, co-ops, property owners associations. And this was a busy legislative session with many very important changes that could dramatically impact the governance of your community and what you need to do as a property manager on behalf of your communities. So that's part one. Part two is going to involve a variety of kind of potpourri topics on the governance of an association, key issues that I see over and over again in the communities that I represent that are important to keep in mind, some practice tips and pointers and pitfalls to watch out for. So let's dive into it. The legislative update, starting with House Bill 1638. This is proposed, and all of these bills that I'm talking about today are very likely to pass and become effective as the operable law come July 1st, with a couple exceptions that I'm going to go through. A few are already established law as signed by the governor. So if I haven't stated that this is adopted, then it is still pending before the legislature, whether it's the House or the Senate, but it is very likely to be adopted.
When would it be adopted? If it was adopted, is there a time frame if it's still pending?
We have one that's scheduled to be adopted tomorrow, so it's a
okay.
fluid situation. Good question. It's a fluid situation where some first hit the Senate, are accepted by the Senate, and then it goes to the House for various called readings of the particular proposed statute. And sometimes on the first reading, the House will adopt it, and sometimes it's the second or third, sometimes not at all. But based upon the experience as it involves these proposed bills, the scuttlebutt, for lack of a better word, amongst community association practitioners, those in the know in terms of the legislative process, this is a nutshell summary of bills that are almost certainly going to become law if they already aren't law. So the first one being 1638, which is establishing a condominium fraud investigation pilot program within the Division of Condominium. It's a test program that's only coming into existence in Broward, Miami-Dade, and Monroe. There's going to be 8 financial investigators that are made part of this pilot program with law enforcement experience. And as property managers, perhaps you've come across instances where it was mismanagement of funds, perhaps even an extreme case of embezzlement or financial improprieties that require some type of investigation. Up until now, it's been very difficult for the Division of Condominium in Tallahassee to handle those types of inquiries. So the legislature is addressing it by virtue of establishing this type of program that's going to strictly be limited to looking at financial alleged improprieties and taking enforcement action against those responsible for the financial impropriety. And when I say financial impropriety, I mean criminal type action. A bad decision in terms of choosing a particular contractor is not a financial impropriety, but stealing of money is. Disappearance of funds from a checking account is. Misuse of a debit card is. So those are the types of things that this investigatory arm of the Division of Condominium will be looking into. Bill 56, Senate Bill 56, requires, and this is a big change for property managers, and we need to be aware of this, and it's a big change for us attorneys as well. It now requires, and I'm not so sure I agree with this particular law, but so be it, requires that the property management company send the first notice to an owner as it relates to a delinquent account. Now that's occurring generally anyway, where if a delinquent owner has missed an assessment payment, typically it doesn't go right to the attorney to send out a collection letter. Sometimes that's the case, but as of the adoption of this pending bill, it's going to mandate that the property management company send out that first notice with a statement of account. Now, interestingly, as part of that process, the property management companies can actually charge a fee associated with that initial letter. Some management companies are doing that, some management companies are not. But because of the way the language reads in this particular bill, this authorizes essentially property management companies to charge a reasonable fee for the generation of that delinquency letter. No attorney's fees can accrue on that account unless and until that first letter goes out from the property management company and there's not sufficient response from the property owner, then thereafter it can be turned over to the attorney for collection purposes, and attorney's fees related to the generation of that type of delinquency notice is chargeable to the account. Next, we have Senate Bill 72. This is signed into law. So this is the law of the land as it stands right now, already signed off by our governor. This grants liability protection to businesses and entities, which includes community associations, from lawsuits related to COVID-19
There's a new
exposure.
bill that's going to be passed tomorrow, according to Scott Wartman.
Hey, Peggy, can you go on mute? We're getting some
I want to
background.
go on mute. Yeah.
Sorry.
Okay.
Okay. So what this law does, or bill rather, it's not, this is a law at this point, 72, grants liability protection to community associations as long as they have made a good faith effort, and those are the key words here, a good faith effort to follow all federal, state, and local public health guidelines. So your association cannot be exposed to a lawsuit, cannot, even though anyone can file a lawsuit for any reason, statutorily, there would be a protection and immunity from lawsuit as long as the association can demonstrate that it made this good faith effort to comply with the edicts of governmental agencies, both local and federal. So that's a good measure for the association, because there's a great deal of concern and consternation of whether or not we should open up pools or common areas for gathering purposes. And as long as you have good signage recommending and edicting rather that there would be social distancing and mask wearing indoors, that constitutes that good faith effort that the statute calls for, which would result in the protection against potential liability from someone that may have gotten sick at one of the events held by the association or at a common area facility managed by the association.
Hey, Scott, quick question for you. What
Sure.
happens if the state differs from what the localities do in terms of the COVID guidance?
Well,
Who trumps who?
Yeah, the executive orders handed down by the governor pretty much across the board preempt any local guidelines. In fact, the executive orders that have been issued have been pretty specific to that effect, that you follow this particular guidance and this particular mandate without regard to what a county may adopt, because you have counties that are coming up with different protocol. It's the executive order at the governor's office that you should follow first and foremost.
Hey, Scott, I want to interrupt you real quick. Jim has a question if this learning opportunity is going to be available on a course outline or a slide. So Vinteum is recording this webinar. They are going to put it on their website. We are going to send out an email. Vinteum is going to send out the first one with a link to the YouTube link to this webinar. Also, everyone's contact information. So everything that we're learning today, we will be able to rewind and use it as a point of reference through the link. So thank you for that. And please continue.
No problem. So a collateral question or issue as it relates to the law that I just summarized is whether or not an association and you as a property manager following the directives of the board of directors, should the association require their membership be vaccinated? Whether or not it's a good idea to be vaccinated, sounds like the science certainly suggests that in a strong way. But mandating vaccination is a different story. The good news is that there's something called the business judgment rule. And that is a proposition that board members are insulated from liability as it relates to decisions on behalf of the association, as long as they are made in good faith, even if it's a bad decision, even if it's the wrong decision. As long as it's not done out of malice and you're not targeting a very specific person, the board of directors does have the right, the discretion to create rules without fear that they would be potentially exposed on an individual basis for liability. However, there are, I think, countervailing factors here that strongly suggest that an association should not mandate vaccinations on behalf as involving their membership, particularly because the acquiring of medical information, which is what you would essentially be doing as a result of mandating vaccinations, has to be kept confidential, and it should be really rarely acquired to begin with. But if it is acquired, it has to be kept confidential. And that documentation, in terms of the proof of vaccination or not, could be subject to a business records inspection request, which will cause the loss of that confidentiality, which may potentially cause the association to face some potential liability. So that's reason number one, not to mandate vaccinations. Number two, generally speaking, there's a principle at play here where you're not supposed to have two classes of members, one who could use the amenities and one who can't. This would expose the association definitely to litigation. In fact, I'm aware of several lawsuits already that have been brought against condominium associations where it mandated a certain individual to not leave their unit or not let guests or invitees ingress and egress out of the condominium association building due to the belief that a certain owner was stricken with COVID-19. Well, that's a different issue in terms of the vaccination. The same principle was at play. You cannot create two different classes of members, one that could use the facilities and one that cannot, based upon purely vaccination or lack of vaccination. And you could also expose yourself as an association if someone believes they do not need or do not want or refuse to get a vaccination based upon religious grounds. You could be exposed as an association to a religious discrimination claim, which adds to the potential for liability. So bottom line, if an association opens an amenity without regard to the vaccination status, all folks should be entitled to use it. That doesn't mean you can't put into place and confirm that masks should be used indoors and social distancing is necessary in compliance with CDC guidelines. Okay, next, Senate Bill 1998. This law has been in place, but there's some clarifying language that makes it very clear that if an officer, director, or manager, which includes you guys, my participants today, who knowingly solicit or offer to accept a kickback, commits a felony of the third degree, punishable by 5 years in jail. So if that doesn't scare you enough into not you or your members of the board of directors shying away from those types of activities, I'm not sure what will. Nothing is worth obviously facing the potential for a third degree felony and several years in jail, even if it's, be careful about getting gifts, monetary or otherwise, in exchange for making sure that that particular vendor gets that job at your community. This particular bill has another part that also talks about official records of the association. Previously, for condominium associations and homeowner associations, the list of business records of the association, which are subject to inspection and to some degree copying, had a kind of catch-all description of financial documents, which was a bit vague, and there was some confusion as to whether or not that general description of financial documents included such things as bank statements, canceled checks, credit card statements, invoice transaction receipts, deposit slips, or other proof of expenditures. Well, all those things I just mentioned now are specifically identified in the statute as a business record that must be produced. It also removes this general catch-all. So the goal, I guess, of the legislature was to be real specific and identify with detail what documents constitute records that the association has to make available within 10 business days upon receiving a proper business records request, inspection request. And we'll talk about what makes a proper one, a proper business inspection records request, and what isn't later on in our seminar.
Scott, when they were talking about the bank statements, if you don't mind, real quick,
Sure.
Can they redact the actual bank account information, or do they have to keep that on there with a records request?
Yeah, that the bank account number is not to be redacted. That's relevant
Okay.
information that they're entitled to know of.
Okay.
Okay, that particular bill also has another component that revises in a way that is very important that U.S. property managers need to understand in terms of business records inspection requests. In response to a request, a proper request again that is received, We can no longer just simply place documents in a room and here you go, here are the documents responsive to your request, have at it. What we have to do, the association, and this falls on you guys as property managers, is to provide an itemized list of what documents are being produced and what documents are not being produced that may have been referenced on the correspondence for the inspection business records request. The reason for this law that's going to come into, certainly going to be passed, is because typically in some of these business records inspection requests, a request will come in and management companies and or associations are just doing what we call a document dump and just or telling folks, hey, go look in that drawer and you'll find your particular document or documents you're looking for. Well, now we have to be specific. We can't get away with just piling up documents in a room and tell them to have at it. We have to have a list of each and every document being produced and each and every document that is not being produced that is on that owner's list. In addition to that, this is a bit of a scary additional feature. The person facilitating the request, which oftentimes is you guys as property managers, must sign a sworn affidavit with the information in terms of documents being produced and documents not being produced. So it's sworn affidavit under penalty of perjury, right? So if there's a misrepresentation in that affidavit and it constitutes a willful violation of these requirements, that is a misdemeanor in the second degree. So if now we have the double whammy of the potential 5 years in jail or a felony to the third degree for kickbacks, and now the additional potential criminal penalty for document inspection requests. So be careful, confer with your counsel for your association as these business records inspection requests. They could be very tricky. They could result in litigation easily, and it could result in a fair amount of liability for the association, who could in turn say, hey, you property manager should have done this right. You should have known better. So the liability could end up resting with the management company.
Wouldn't you recommend that they reach out to the attorneys before? I would recommend that if I was on that side, because they're signing something and they're taking liability on.
Absolutely. And that's a common practice with my communities. When they receive one of these, I oversee the process to make sure we're acting in conformance with Florida law, and that is the right way to go. Once in a while, we'll have a management company decide to do it on their own, but that's not advisable, because as we're seeing with these new requirements, you could easily get tripped up in terms of the business records procedure. Okay, passed yesterday is Senate Bill 630. So this will be adopted and effective come July 1st. It's going to the governor's desk for signature, which he's expected to sign undoubtedly. So come July 1st, the following new components to condominium and homeowners association governance applies. This is a good one. The fee for transfer of a unit, which includes a lease or a sale, has been increased from $100 to $150. Again, that's as of July 1st. So don't shoot out the demand for $150 to process the rental application next week. It's still $100, which I definitely agree with all of you. I mean, I can't see you, but I'm sure you're all nodding your heads. $100 is way too low to process these rental applications, because the background check alone sometimes is more than $100. So at least they're increasing it to 150. And they also added a component to it indicating that the 150 will increase every 5 years in conformance with the consumer price index. As that goes up on average, 2-3% a year or so. Is that fair to say, Nicole? The consumer price index is on average a 2 or 3% increase. So you'll see that 150 graduate upwards over a 5 year.
5 years. Okay.
Also, the owners now have the absolute right to install electric charging stations at their designated parking space. As the advent of electric vehicles, and there's more and more of them on the road, the legislature is trying to keep up with the times and make sure folks have the right to install these charging stations, which is a good idea. Now, the associations have a fair amount of protection, whereby if the installer of that charging station isn't paid by the owner who wanted their charging station placed at the forefront of their parking space, and a lien is placed on that, the association has significant legal rights as against that owner to ensure that that liability gets discharged immediately and the lien is released immediately. The association also has the right to approve the manner in which the charging station is going to be installed. It's not up to the owner to put in whatever they want. They still have to go through the approval process. And as long as it's reasonably exercised, then the charging station should be approved. There's also now, as part of this bill, the owner's right to install a natural gas charging station. I don't see a lot of those out there, but nonetheless, the legislator added that to the electric charging station component to this bill that just passed on Tuesday. This is also a big change as it relates to condominium associations. As it relates to homeowners associations, when there are disputes that cannot be resolved through a few phone calls or emails, before the association decides to initiate a lawsuit, there's a mandatory pre-suit statutory process involving mediation. We have to go through mediation first. We have to make an effort to do that. And if the matter is not resolved at that pre-suit statutory mediation, then the association has the right to file a lawsuit. Well, that now also applies to condominium association, which I see as a positive, because the alternative, as it stands today, the condominium association, to resolve most types of disputes, would have to file an arbitration action with the Division of Condominium. An arbitration action is a much longer process, very expensive, a bit unpredictable, even though we have hardworking arbitrators over there at the Division of Condominium in Tallahassee. The mandatory pre-suit mediation is an option now for condominiums to utilize. And if the matter cannot get resolved, or it's a serious enough situation, the condominium association will then have the opportunity, if they so choose, to then file a lawsuit if mediation was unsuccessful. So that's an important alternative dispute resolution element that's now available to condominium associations.
Hey, Scott, I got a question.
Sure.
There's a lot, and Brooke also has a question. I was wondering the same thing. There's a lot of older buildings in South Florida, and the power grids on those buildings might not be sufficient enough to add a charging station. If that charging station is not sufficient, would it be possible, or would the resident have to pay for that upgrade? So there could be some cases where it just isn't an option for that option.
Yeah, that's a good question, and that has not come across yet, either in a case, an arbitration, a lawsuit. But if I were to posit on this issue, I would say the association, in all likelihood, has an obligation to have sufficient electrical power to support these charging stations from being installed. If the statute bestows upon the owners and the members the right to install these stations, then it's incumbent upon the association to have the infrastructure necessary to support it. But again, I don't have a case to point to say that, and it's a unique legal issue. But I would err on the side of, if this came up in your community, I would probably advise the board that they have an obligation to make sure there's sufficient power to support these charging stations.
Now, who would pay for that? Was that the association's responsibility to pay for that?
That'll be an association common area expense, because it's infrastructure associated with the association activities on common areas. So while it is supporting the usage of a limited common element, I think it's incumbent upon the association to have the infrastructure there, which is a common expense of the association.
Right now, the way that it is there might be a few spots that have these charging stations. But if you're in a 130 unit building and everybody decides to buy a Tesla, then the board is going to have to make a significant investment to make sure that they can provide for 131 of those spaces from a power standpoint.
That is possible, and the association could be faced with the imposition of a special assessment on all the members for that purpose, or sufficient monies are in an operating account, potentially in reserves for that project. Monies could be used for that reason, from those sources. But it's going to be an association expense, whichever way they decide to raise the funds, if they don't already have the funds available.
Yeah, this is interesting. As the electrical cars grow, as a Tesla owner myself, It's going to be very interesting to kind of watch this grow. What if it's put in and then they move out? Does that stay there? Is it their property? Do they take it with them? I know you don't have all the answers now, but we'll, we're going to continue to watch this one. So we look forward to kind of your updates on this, because I know you send out emails, twice a month. So,
And to answer that question, the parking spaces being a limited common element, go with the unit owner. So if the owner sells their unit, they're selling their parking space, as is, in whatever condition it exists, which includes that charging station. So the new owner is agreeing essentially to purchase the condominium unit and also, or HOA home, as well as that space that has whatever structure there, charging station, electric or gas.
thank you.
Yep. Okay. Also, as part of this this law passed on Tuesday, there are many components. This 630, the Senate Bill 630, which was adopted, where the homeowner associations they can adopt a procedure noticing all meetings on a website or in an app that is maintained by the association. However, there's still an obligation to notice board of directors meetings in a conspicuous location on association property. So it just gives the association the additional notification option here of doing it on the website, on their app, but you still have to place that notice up front, typically at the guardhouse or in the common area. So be aware of that. This also is good for, important for Bill and for Nicole, where homeowner association reserve accounts now can be created by an association without having to obtain a membership-wide vote. Now, reserve accounts are mandatory in the world of condominium associations unless properly waived by the membership. Homeowner associations are very different in terms of reserve accounts. There's no mandatory obligation to have reserves, except in very rare cases where the developer established reserves at the very beginning of the community, and there's language in the governing documents to support the mandatory nature of establishing reserves at your homeowner association. If none of that occurred, where the developer didn't establish it and you don't have the language in your governing documents to establish it, then the HOA had the option to create mandatory reserve accounts, but required a membership-wide vote to do so. This statutory provision takes away the obligation to get the membership-wide vote. A board action alone is okay to establish a mandatory reserve account, which could be good, could be bad, depending on how you feel about reserve accounts and how it could impact the budget and your annual assessments.
So Scott, would they have to say at a meeting that they're voting it as a statutory reserve versus a board reserve? Because a board can establish the board reserve. How would we know? Would they have to say that it's going to be a statutory reserve?
Yes, it would have to be stated in the notice that it's a statutory mandatory reserve that's to be incorporated as a component to the budget each and every year. So, okay. And I think what you're alluding to, Nicole, is that even if there aren't mandatory reserves, it's common for homeowners associations to set up contingency accounts, which are funds set aside for rainy day projects, big projects, which is perfectly permissible. A lot of communities do that, but the nature of those particular contingency reserves are not, those funds are not locked in for a particular purpose. The association can access those contingency reserve monies for any reason whatsoever. But once you place monies in a mandatory reserve account, it can only be utilized for the particular big ticket items that an association typically has to address, whether it's paving of roads, replacing of roofs, etc.
Painting.
Exactly.
Now, this is kind of the biggest one that I've, that's come across the desk, because there's a lot of times we come across where communities just do not have the assets and they don't have the means to kind of save for those large projects. And to be able to do that without a vote, they could put this in motion tomorrow for a roof reserve or, anything else of that manner that has to be in that category that they've selected. So this is going to create an interesting opportunity for boards and managers to go ahead and earmark money for certain projects without a vote. So do you feel like you're going to get, for lack of a better term, a lot of noise and a lot of questions on that topic compared to the other ones?
Well, no, and the reason is most boards, although some are very concerned about perhaps not having adequate reserves, most boards of directors are more focused on how is this going to impact assessments on a year-over-year basis, with the goal of trying to keep a lid on the assessments increasing. So if we're going to add a component to the budget, and this should be adopted as part of the budgetary process, not mid-year. And so as part of the budgetary process, if there's a new component added to the overall budget, the boards tend to want to see how this is going to impact assessments on a year-over-year basis. Maybe it doesn't have a dramatic impact and it's a fine idea and it's incorporated. But I see less focus on the need to have greater reserves among board members. And I'm not saying that's the right thing, but it's kind of short-term political thinking in a way. But that's generally the way boards of directors view budgets and view how budgets are going to impact assessments on a year-over-year basis and how the members are going to react to it.
Thank you. Keystone Property Management, I hope that answered your question. Thank you.
Can I ask a question, Scott?
Sure.
Was there any discussion about the law, supposedly, I think in 2025 or 2026, where it's going to be where all associations are going to have access for this, for the access for charging the cars, charging stations. So is this like in preparation for the reserves for that future drop dead date? Because the cars are going to be starting to be produced strictly with charging station requirements.
Well, I think to Rudy's point, where you have the ubiquitous nature of electric vehicles starting to hit the roads, we have to have the infrastructure to handle these cars. And for the convenience of making sure cars are being charged at your home site, that's what the legislator is seeing as important. To make sure that folks have the ability to install an electric charging station at their dedicated parking space. And sure, down the road, as it relates to goals, federal goals for 2025 or 2030 or whatever the case may be, to have a certain percentage of vehicles on the road as being electric in nature and to reduce the carbon footprint. I think it's all part of the consideration here. Let me move through a few things because I want to give Nicole and Bill an opportunity to speak, and we've got a lot of topics, so we could go on for 5 hours.
Great information.
Let me try and run through a few more. This is a big deal for homeowners associations, where, and I'm going to discuss this idea, this new law that's going to come to play come July 1st, in the context of what do condominium associations have in place, and what condominium associations have in place in terms of rental restrictions. Let's use a hypothetical. Let's say the board of directors wants to adopt an amendment to their governing documents stating that this community is no longer allowing renters, period. There's a blanket rental prohibition. They could do that, and an amendment could be adopted to that effect with the requisite vote of the membership. It's not a board vote, but a membership vote. However, big caveat there, if a particular owner does not vote in favor of that particular rental restriction, this is again the condominium association context, then that owner is not subject to that blanket rental restriction. So that's how it exists in condominium association world, not how it exists today as it relates to homeowners associations, but that will be the case come July 1st, meaning post July 1st, if your homeowners association board of directors says we want to restrict rentals in a big way, and there are certain exceptions, which I'll get to in a minute, but we'll take the example of just a blanket rental restriction, and we acquire the requisite membership vote to adopt an amendment to that effect, which is a big deal, hard to do, and we went through, I've done that several times, and it's a Herculean effort to get the folks to vote for anything, but if we acquire that necessary vote, post July 1st, that rental restriction in a homeowners association, just like now, just like in a condominium association, if that homeowners association member has not voted for that particular rental restriction contained within an amendment, then that particular owner is not bound by that rental restriction. So important procedural item as it relates to renters and proposed changes to how your community is going to look and feel vis-a-vis renters. There are a couple exceptions, thankfully, where the association, the statute says, the association can still adopt restrictions involving tenancies of 6 months or less. Another word for 6 months or less also could be described as Airbnb, VRBO. Big issue in a lot of communities where the Airbnb, VRBO type tenancies, even if you could describe it as a tenancy, maybe it's a license, are problematic in a lot of communities. The transient nature of folks going in and out of communities on a short-term rental basis is not desirable by most boards. And so there's been many efforts among associations that I've represented to curtail that. And this statute and this bill that's going to become a law July 1st that I just read through allows for boards to still create their own restrictions in terms of not allowing these short-term renters. And when they say short-term, it's 6 months or less. Also, the association board of directors can also create restrictions where a member cannot rent their parcel, their home, for more than 3 times per year. So that's another way that the association can seek to limit, restrict the Airbnb, VRBO type arrangement that goes into some communities. So that's a good carved out exception that helps associations. And these particular new rules coming into effect July 1st do not pertain to any associations with 15 parcels or less. So if you're managing a small community of 15 units or less, this doesn't apply to you. Okay. Senate Bill 1966, not adopted yet, but probably. Previously, if there was an individual running for the board of directors and they were delinquent on any monetary obligation, which includes fines, that would render them ineligible to run for the board of directors. This now proposed statute, probably coming to law July 1st, now says that the candidate must be delinquent on unpaid assessments. So if there's an outstanding fine that this candidate has not paid, that does not render this person ineligible to run for the board of directors. So keep that in mind. And also, the unpaid assessment must be connected to specific language in the declaration that says when an assessment is actually due. I've reviewed God knows how many declarations of condominiums and declarations for homeowner associations, and actually rarely does it say when assessments are due. It's just kind of known that it's due the 1st of the month, perhaps no later than the 15th. Some documents say that, but that's rare. So this could trip up you folks as property managers and the board in terms of rendering a candidate ineligible if they're delinquent on assessment, if your governing documents aren't specific enough as to when an assessment may or may not be due. So keep that in mind. Okay. Lastly, recall petitions. We all love those when the members are trying to throw out the board of directors or one or more members of the board of directors. Well, there used to be a fairly low starting point to be able to get that process off the ground. Well, the legislature, which in their esteemed wisdom in this particular case, says, let's make it a little more difficult to throw the baby out with the bathwater here, and requiring now that 60% of the owners, all of whom must claim that particular home as their homestead through the property appraiser's office, must sign that petition to get the recall procedure off the ground. There's a secondary aspect to this, namely 51% of the members must vote in favor of recalling one or more members of the board of directors. But the starting point now is 60% of the members must sign a petition to this effect. And out of those folks, each and every one of them must designate their property that is contained within the association as their homesteaded property. So procedural item as it relates to recalls. Okay, that's the legislative summary and update. And now we're going to go into practice tips, governance issues, And the first topic, Nicole and Bill are going to run with about annual audit obligations of an association, which is timely. So Nicole and
Thank
Bill.
you. Scott, great information. Kudos to you. That was very impressive. I learned a lot today, and I'm glad that I think a lot of managers did too. A lot of changes to legislative. So great, great topic.
Thanks, Nicole. Check is in the
Annual-
mail.
Yeah. Annual audit obligations. So this is very important, especially April 30th is on Friday, making sure that your association is abiding by the statutes because you don't want a unit owner turning you into the state. This applies to statute 718, 719, and 720. All the audit obligations and financial reporting are all the same for all the statutes. So what came about, I guess, 2 years ago, for 2019, there was a major change to the accounting standards. And the reason I'm bringing that up is there is some conflicting what people are saying, what you're required to do on the auditing standard. So let me explain first what the statutes require. If your income is over $500,000, and that includes all income, that includes special assessments, reserves, anything that you're collecting on the revenue side is revenue. So anything over that $500,000 mark requires an audited financial statement by a CPA firm. If your income is $300,000 to $500,000, you're required to do a reviewed financial statement. That's a lower level of service than the audit. It's basically analytical procedures that we're doing and taking your financial statements. That is also done by an independent firm that is coming in, looking at it and reviewing your financial statements. A compilation is required if your income is $150,000 to $300,000. However, nowhere in the statutes it states that it has to be done by a CPA firm. And the reason I bring that up is if your management company or your people that are preparing your financial statements have the ability to do a compiled financial statement, that includes footnotes, that includes the compilation letter. It's not required by the CPA firm. You're able to do that. But you want to make sure that they're including all the full disclosures that are required by statutes. And they are issuing an accrual-based accounting. It cannot be done on the cash basis. So it must be done according with accounting standards. What happened was in 2019, accounting standards changed the way revenue is recognized, and it's a major change. What happened was on the reserve side, they said when you budgeted for reserves, on the statute, it says you budget and you put your operating and you put your reserve, and that's all revenues. So on your budget, you might have, let's say, $1 million worth of revenue. Under the statutes, that is required to have an audited financial statement. Now you go to do your audit. What happens now on the accounting standard side is you're operating, let's say your operating is $400,000. And then you budgeted $600,000 for reserves. Well, if you didn't spend anything in reserves in that year, all of that money now goes onto your balance sheet as something called a contract liability. It's deferring the revenue till you spend it. So on the audit, your revenue would only be $400,000. So we reached out, I'm a member of the CIRA committee. We reached out to DPPR and said, how are you going to handle this? The budget is showing $1 million, but on their financial statement, their income statement shows $400,000 and $600,000 of it is deferred for future obligations in those reserves. The answer came back to us was, we haven't had an issue yet. Nobody's turned it in yet. So my recommendation as an outside auditor is I would be going by what your budget states. The statute doesn't say that, but I would be going by what you're budgeting for revenues, which includes reserves, it includes operating, and I would base it on that because in the future, you're going to recognize those reserves as revenue in the future, and it will be over the $500,000. Now, if you're required to have an audited financial statement and the board says, we don't want to do an audit, we want to do a lower level of service, it is not allowed by the board of directors. It does require a membership vote to lower the level of service. So if you're required to have that audit and you want to do a review or a compilation, you would be required to go out to the membership to get a vote to lower that level of service. I would recommend if you're over $500,000 and you're a board of directors and you're required to have an audit, I'd most likely be doing an audit, because I would be saying, I want to make sure I disclose, I give all that information to the owners, and making sure everybody is looking at those financial statements from an independent CPA firm. If you want to increase your service, so let's say you're required to have a compiled financial statement, your income's $200,000, and you want to have an audit, that is a board's decision. A board can increase it and say, we want to go up in level of service. It is only a board vote. Now, the only other side to that is if your documents state differently, and this would be a question for Scott, your attorneys, is if your documents state you're required to have an audited financial statement, and the statute says you're only required to do a compilation, which overrides either? Which is, does their documents override it, or does the statute? I always tell my boards, we need to get a legal opinion. And then if they're required to have an audit, can they get a membership vote to not have the audit done and do a lower level of service? And that would be a question also for your attorney. I've had many that have it in their documents required an audit, but their income doesn't fall under that. So in that situation, I always say, reach out to your attorneys and let them give you a legal opinion on what you can and can't do. Also, in those situations, sometimes those documents are so old, we recommend go to your attorneys and update those documents. That's the most important.
And Nicole, if I could ask a quick question as it relates to when you use the word income. When we say income, we're talking about obviously the assessments that are collected by the association. Does that also include, you say, applications involving, renters or rental receipts, rental income received as involving properties owned by the association, or is it just limited to assessments?
Great question. So it's all income. So if you have laundry income, you collect renters fees, you collect any type of revenue income, it is all included. It is not just the assessments. So it's special assessments, and laundry income is usually one of the typical examples because that's usually other income. Also, if you have antennas on your roof, that would be considered revenue if you're collecting that from a third party. There's another tax situation with that, but from a statute standpoint, yes, that would be all revenues. And that is required to be done. So if you make a decision to vote to do a lower level of service, it must be done by year end. I've had associations where they say, well, we're going to do it at our annual meeting the next year. By statute, it needs to be done by the end of the year. So you want to make sure that if you're voting, and you can vote up to 2 years. So you could do 2 years voting to do the lower level of service, but make sure it is done before year end with those annual requirements. It is also required to have it available to the owners by April 30th. The statute states it must be done 90 days after year end, 120 days to the owners. So what we tell our boards is try to have a draft done by the beginning of April, because you want to make sure that it is available by April 30th, that someone doesn't have the ability to turn you into the state and have them come out and look at your association and say that you weren't filing it timely.
Hey, Nicole, so
Yes.
if a financial statement is required, must that be voluntarily shared with condo owners by the condo board, or can the board require an official records inspection request?
Great question. So yes, it's not an official record request. It is required to be available to the owners. So if your documents doesn't say you have to mail it out, what I tell my boards is send a postcard saying it's available, and then they can come into the office and get a copy. They could be emailed a copy if they opted in electronically to get those. But yes, it's not a records request. It must be made available to all owners.
Nicole, what kind?
So done by a CPA or just an audit? Like, does the review have to be done by a CPA, or that depends on the tier of income?
Great question. So reviews and audits can only be done by CPA firms. That's what they're required. Compilations are not required to be done by a CPA firm.
Thank you.
Nicole,
Yes.
Nicole, what kind of feedback have you gotten from our associations this year with respect to that new classification of the contract liabilities on the balance sheet? Has it been confusing for most associations?
So we have 700 clients. I probably had 625 meetings this year. Nobody understands it. So there are people that are CPAs that are on the board, very confusing. What I recommend to every property manager is meet with your CPA firms, get an understanding of it, have them explain it to you because it's very confusing. Do a closing meeting when you're going over the audit so you understand it, because it's a major change. You're going to look at your fund balance now, your equity and reserves, and it's gone. It's no longer there. Also is educating the real estate agents out there that are buying into your communities, because we had a situation, I guess it was last week, I got a call from one of the managers saying somebody was looking to buy in here and said, you had reserves last year and everything's gone now. The board spent everything or somebody stole it. The money wasn't stolen, the money's there. It's just now on the balance sheet as deferred revenue versus the equity section. So it has become very convoluted and confusing. So we did a class last year on this, and we will be offering a class this year to educate everybody on understanding this new accounting standard, because it has been a major change.
Is it only relates to the balance sheet presentation? Do you suggesting that management companies change their chart of accounts in the way that they're accounting for it on a day in and day out basis, or how does that work?
Great question. We are telling our management companies and our self-managed properties, they can continue to do it the same. It is only required on external reporting for GAAP, generally accepted accounting principles. So the internal reports, our management companies are leaving them the same. If they change it, that's fine, but most of them decided to leave it the same because most people don't understand the new accounting standard. It's a great question. So that's the part on the annual audit obligations.
Great. Thanks, Nicole. Terrific.
You're welcome.
Okay, next topic. And some of this is fairly basic, so I'm going to cut through some of the basics quickly, but highlight some important aspects of how to run a board of directors meeting. For you property managers, I'm sure that's the most fun part of your job, attending board of directors meetings. And as you well know, it is the president's role to run the show during the board of directors meeting. If the president's not there, the vice president takes over. You also, I'm sure, are well aware that you need a quorum of the board in order to conduct a board of directors meeting. Now, this particular element, the need for a quorum, actually has an important component in the reverse, in the sense that in informal get-togethers of the board of directors, in the hypothetical, say, where you have 5 members of the board, 3 of whom are pretty good friends and decided to grab a beer together, and what happens is commonly association business is discussed. Guess what? That's a board of directors meeting, because you have a quorum of the board getting together to discuss association business. Now, I'm sure that get together at the local tavern over some beers was not noticed to the community in that hypothetical. So you'll be running afoul of the notice obligation for board of director requirements. So just remind your board members that a quorum, a majority of them, cannot get together informally, even if it's initially done just for social purposes. But if it devolves into a conversation about association related business and someone gets word of that, the association could have a problem with failing to notice that particular get together as a proper board of directors meeting. Also, I hear this all the time. Scott, we want to have an executive session. We have some very important things we got to discuss, so we're closing the meeting to the membership. Well, usually that's not proper. There are only two scenarios where a closed meeting is okay. And that is when there is a discussion to take place involving pending or threatened litigation. Pending or threatened litigation, and your attorney is present, whether it's on Zoom, on a conference call, or in person. So that's one category where you can close the meeting. The second category where you can close the meeting is if there's going to be sensitive personnel issues discussed, potentially the hiring or firing of someone who is an employee of the association. That can be deemed a closed meeting where the membership would not be invited. Aside from that, there are no other closed meetings. There's no such thing as a workshop. I've heard that term used over and over again. Scott, we got to get together to figure out which contractor is best for a particular project. And we can't have the membership there. It's going to be an inconvenience and interfere with our discussions. That's a no-no. Although it sounds logical, It's not proper, and it violates both Florida's Condominium Act and Florida's Homeowners Association Act.
Hey, Scott, if the DOC requires 5-member board of directors and they're operating with 4, can that be challenged?
No. I mean, it all depends on why there is 4 versus 5. If there was 5 and someone dropped out, resigned, moved away, etc., then it comes down to oftentimes one word in your governing documents, may or shall, because in virtually all sets of bylaws, not the declaration, but the bylaws, there'll be a section talking about the resignation or death or disability of a member of the board of directors, and whether or not the remaining members on the board may appoint someone to replace that resigning board member, or shall appoint that person, appoint someone to replace that person. If it shall, then the board has to get going and find someone and solicit the membership to replace that individual. If it's may, they could wait until that term expires. It's discretionary in nature. So that, I hope that answers your question.
Thank you.
Yeah. Meeting minutes, you guys are, I'm sure, super familiar with meeting minutes and their importance. But why is it so important? It's important because if a particular action of the board is challenged, let's say a special assessment vote or a material alterations project, and the member files either, today it would be a condominium association arbitration action in the condominium context, or with HOAs, maybe it ends up being a lawsuit after pre-suit statutory mediation. The backup to support the decision that the board actually went through the machinations, the actions to formally adopt a certain special assessment or project or hire a particular vendor are to be set forth in these meeting minutes. So the meeting minutes are not there just, so it looks like we're busy. They're there to support, memorialize, and confirm what the board did at a duly scheduled board of directors meeting. So keep that in mind. Keep in mind also that, and most of the property managers I deal with are very good at this, just referencing who made the motion, who seconded the motion. And then after that, sometimes what is kind of rushed through is a motion is made, a second is made, and then a vote is taken. Technically, what's supposed to occur is a motion is made, a second is given at the board of directors level. And then if members are present, there's supposed to be an allowance for the members to chime in, to give their 2 cents as to the issue before the board, not after the vote of the board of directors on that particular item, because at that point it's too late. And the members are supposed to have the ability to speak for 3 minutes on that particular issue, in theory, to influence the decision-making of the board as to that particular item. So make sure you allow that process to go forward and not just skip past allowing the members' right to speak, although sometimes I know that could get unwieldy, could be uncomfortable in certain cases if it's a contentious issue, but it's an important procedural parliamentary item. Another thing that I see routinely, which is not supposed to be done, is voting by email. So boards of directors are not supposed to approve or disapprove of a particular action by email. That's all supposed to be done at a board of directors meeting, including the deliberations as it relates to that item. The policy behind all this is to give the membership the benefit of the deliberations, to see what board members feel what about a particular topic, not have everything be done behind closed doors or by email outside of the sunshine of a board of directors meeting. It's kind of synonymous with the Sunshine Act, sunshine laws involving governmental agencies, where only the deliberations and actions of a governmental body are supposed to take place in the sunshine, out in public for the members, for the citizens to see. The same concept is true with HOAs and condos. So we still see the email communications back and forth. So really advise your boards to shy away from that as much as possible. There are a couple small exceptions to this rule, and I'd like to kind of use this example where something is so ministerial in nature, maybe a scheduling issue, not heavy in terms of the substance of the item. The example I use is the property manager sends an email to the board saying, hey, the pool guy wants to come out Tuesdays instead of Thursdays. Does that sound good to everyone? Something like that, I feel is small enough from a substantive sense that it could be discussed and voted upon via email. But other things like, hey, repairing the pool, should we choose this guy, this contractor, or that pool contractor? And should we spend 50,000 or 100,000? That should not be done email wise back and forth. There are other exceptions such as emergencies. If a hurricane is bearing down on us, we're entering into hurricane season. We have to make arrangements to do this or do that in preparation for a hurricane, or like we saw with the pandemic, some quick decisions had to be made to shut down the pool, the clubhouse, etc. Those things can be discussed via email in an emergency situation pursuant to the emergency powers set forth in the statute. And actually, one of the items that actually I forgot to mention in terms of the legislative update was to clarify that emergency powers also involves and includes health crises like what we're going through with COVID-19. Before, the language was kind of vague in general, and most community association attorneys, practitioners were interpreting that as incorporating, including the pandemic. But now we have statutory language that absolutely expressly states that includes health crises like the pandemic. Okay. I talked about the exceptions involving emergencies, the notice requirements. It's fairly standard, but bear in mind these kind of general rules of thumb. It's 48 hours notice for general board of director meetings. It's 14 days notice to adopt a special assessment. And the special assessment notice has to be really specific. And I do see some errors, frankly, from some of my property manager friends where they shoot out a notice that does not contain all the requisite special assessment information. What information has to be in that notice of a special assessment meeting? The gross amount of the expenditure of funds for the particular project that is causing the generation of a special assessment, what the actual special assessment per unit owner is going to be, how it is going to be payable, and when it is due. All those pieces of information must be incorporated into the notice of special assessment sent out to the owners at least 14 days in advance of that meeting where that special assessment is to be adopted by the board of directors. Failure to include that type of information could render the board of directors' decision to impose the special assessment invalid on its face, rendering these special assessments potentially uncollectible, which would be a major problem for the association as involving a project they need to pay for in the very near future. Okay, so those are my practice tips involving board of directors meetings. We're now going to hit our next topic, which I'm going to shoot back to Nicole and Bill, involving the preparation of budgets.
Okay, great. Thank you so much.
Yep.
So let's talk about budget season. We're not in budget season for most of you. Some of you are, but the most important part of budgeting, and I do teach a class on it, is stressing about estimates. Too many of the board members try to do budgets and try to get it down to the dollar amount. That's not going to happen. You need to look at it from a perspective of an estimate. You need to look at last year's amounts, actuals, look at what you project through the end of the year. So let's say you're in September preparing your budget, which I always recommend July or August, especially if you're a calendar year end. And you want to project out to the end of the year, what you anticipate spending. And then look around too. When you're doing your budget, I always tell my associations as a manager or a board member, walk the property. Why? You want to look at things that are starting to go down. Is your painting? Are we going to need to do painting next year? Roof, balconies. Do we see things that are coming up that we don't anticipate? It doesn't mean something won't come up, but walking that property, looking at our landscaping. Do we need to plant more flowers? Do we see things that are going down? And add that into your budget. Also looking at when you're doing your budget, I always recommend sending letters to your vendors and saying, are you having a price increase next year? It can't hurt for them to fill it out and say, we're looking at maybe a 5% increase or a 10% increase on the contracts. So when you're doing those budgets on things that you can anticipate, you can come close to what that number is going to be in the next year. The hardest thing to anticipate in a budget is repairs and maintenance and your contingency line item. If you're not funding reserves at all and you're getting the vote of the membership to waive those reserves, you really need to have in your operating side a contingency line item. You need to make sure that you have something set aside for things that come due. hurricanes that are coming due? Do you have set aside an insurance deductible? If you don't have that set aside in a non-statutory reserve, where are the funds going to come from? Are you going to have to special assess? People don't like that word, but if you don't have backup, it's either special assess, put into the maintenance fees reserve, contingency, and reserving for those large components that are coming up. So if you now are doing your budget and you're sending out the vote to the membership to waive the reserves or partially funding, that does require the membership vote. One of the things that a lot of boards don't understand, and they don't understand the statutes, when you're putting out a budget and you want to fund those reserves, you are not required to get a membership vote to fully fund reserves. So if you want to fully fund the membership, the board members can put out a budget fully funding and never get a vote of the membership. If you are a new building or you're a building that has been funding reserves, that's an easy thing to do because those maintenance fees won't drastically go up. The hard situation is communities that have waived the reserves or partially funded so low to fully fund. That would probably be nearly impossible in a budget because we know that the fees would go up drastically if you're not in that situation. But it is something to think about. I have to tell you, this was an interesting story that we started with some of our associations that were getting the membership never wanted to fund reserves. So the board was always putting out the ability to waive the reserves or partially fund them. So a new board got on and said, we really need to be setting aside for reserves because major projects are coming up. We're being special assessed every year. It's hurting our resale values. How do we go about handling that? So we sat down with the board and with their attorneys and we went through a list of things. And what they started doing, this was over 10 years ago, they started it. They got the membership to waive the reserves. And then they would put into their budget contingency line items and they'd have surpluses every year. And then they would take those surpluses and move them into a non-statutory reserve because they're not statutory because the membership voted not to have them. Then after they build up a large amount in the reserves, they went back to the membership and voted them into statutory reserves. When the membership saw that this was really beneficial, the membership really changed their thinking of reserves and they started funding reserves. And now they're at a point where they're actually fully funding reserves. So there's ways to do this to educate people on the side of reserves. We're noticing more and more communities are starting to partially fund or put something into reserves because they really see it affects the value of their community. People don't want to be hit with those large assessments. They want to put aside, $100 a month versus $10,000 or $20,000 in an assessment. So people, and especially with Florida's real estate right now, how it's booming and everybody wants to be in Florida, they want to buy in the communities that are financially secure. So when you're doing your budgeting process, I always say, start with the expenses. Do not start with the income. It's like walking into a car dealership and saying, I want to pay $200 a month. You don't go in and tell them that. You go in and you start with those expenses and you work backwards. Because if you start with the income, you're going to cut line items in those expenses that you need to budget for. Utilities, it's hard to anticipate what those expenses are going to be, but you can anticipate what the increase is going to be and looking at those line items. And then reserves. Reserves is a huge part of your budget. It's actually one of the most important in regards to the calculation. It's very important that if you're on the component method or the pulling method of reserves, you're doing the calculation correctly. When you put out your budget under 718, you are required to put a reserve schedule with the budget, even if you're waiving the reserves. And I've had board members say, well, if they're waiving the reserves, why do we have to have that schedule? What are they waiving? If you don't give them a schedule of what they're waiving, they're just waiving it based on a dollar amount. They're not understanding the concept of that reserve, painting, paving, roofing, major components that they're waiving when they're going to be special assessed down the road. So it's very important that that schedule is attached to the budget. And how did those numbers come about on that reserve schedule? So the statute doesn't require that a reserve study is done anymore. I'm kind of disappointed they did take it out because I think it is very beneficial for communities to have those reserve studies, especially when a lot of them are having the boards put them together. And a board will come in and say, well, I was a roofer many years ago, which I don't know what that means. I was many years ago, just like I was a CPA many years ago. I don't know how that changes now that you're older, but they come in and say that roof's $200,000 when really the roof's $1 million. Or the painting, they put a number on it and it's not accurate. And what's happening is they're putting these numbers together and then they're saying we're fully funding because those numbers calculate out to fully funding. But what the problem is those estimated replacement costs are wrong, drastically wrong. So when that item comes due, they're never fully funded and they're always having to special assess to have those items done. Then the last area of the reserves that the state of Florida, actually DPPR, we work with them and teach them on financials, understanding the reserves from that perspective. They say the number one complaint is the pooling reserve schedule. It's never done correctly. So if anybody wants a copy of our schedule, we've created one in Excel that works perfectly. All you have to plug in is the numbers. Why they're being done wrong is, let's take painting, typical example. Let's say painting has to be done every 7 years. Your pooling schedule has to go out to the longest life of the asset. So let's say that technically that would be concrete restoration, but we know many people don't put that in their reserves. The most costly on the building, they put roof and they say roof will last 25 years. So they take the schedule out 25 years. They put in the pooling schedule painting to be done in year 7 and they never put another expense again. Well, painting has to be done in year 7, year 14, year 21, and it needs to be included in that schedule. And it doesn't. They end up putting the expense in one time. So the schedule is usually not correct. And they do sometimes include inflation. And it specifically says in the statute, you're not allowed to include inflation in your calculation. So people will say, well, how do we change that number in the pooling schedule? Because we know the funding needs to go up. The pooling schedule has to be redone every year. So when you redo the estimated replacement costs, they're going to go up. And that's how your funding would go up, because the next year when you redo it, that funding will change. So it's very important. I cannot stress enough that you need to make sure in the pooling method or the component, those calculations are correct when given it out to their owners. Also
Nicole, the spreadsheet has really struck a nerve. People are asking where they can get a copy of that spreadsheet, the reserve schedule spreadsheet. I would tell them to, number one, reach out to you. That'd be probably the quickest way. So for everybody that's asking about the spreadsheet, please reach out to Nicole and she'd be more than happy to help you out.
Yes, and if you email me at no cost, I will email you those spreadsheets. I have one that goes 20 years and one that goes 30 years, and I'm more than happy to supply that to you. The other area of the budget is the tax area. Is many associations, as me and Bill noticed in 2020, that they were being subject to tax and they're not including it in their budget. So I'm going to have Bill talk a little bit about what is taxable and if you should reach out to your CPAs, if you should be finding out if there is a tax consequence.
Hey, thanks, Nicole. Actually, just yesterday, we had an association reach out to us about their budget for the next year and increasing the profitability of some of the work order work that they do and also some of the home minding services that they have. And they wanted to know what that impact was going to be on their tax return. And most associations do pay tax. They pay tax on items and revenue that they collect that don't come directly from the owner in terms of a quarterly assessment. So as Nicole had stated earlier, what are some of these items? We're talking about interest income, whether it be from the operating or the reserves. We're talking about rental income. There might be some condominiums that own some units that they're renting out. It could be rental income from parking spaces at condominiums. It could be laundry income. It could be antenna income. There's a number of associations that have antennas on their roofs and they're getting money for that. It could be, we've seen now in some associations, having pet fees every year. So this is a type of income that is subject to tax. And at the end of the day, you can put expenses just like your Schedule A on your itemized deductions. You can take deductions against it, whether they're direct or indirect, but there's a certain dollar limitation as to the total. And so what we've seen now over the past few years is that this revenue's increased that's been subject to tax, and the expense level that they have has stayed relatively the same, propelling them basically into tax. So it's always good when you're doing a budget to also ask us what items are going to go into a reserve that are going to be for future capital expenditures. Why is that important from a tax perspective? Is because you gain basis. It's considered a capital contribution by the owner for any type of future capital expenditure that you're funding, whether it be a special assessment and or a reserve. There's some requirements associated with that where you've got to put those funds into a special account, a separate account, in fact, from your operating, and you've got to make sure that it's used for future capital expenditures, not for painting, not for a contingency, not for hurricane overages, but for a capital expenditure, as Nicole said, maybe concrete, maybe roofing, maybe pool work, whatever it might be. And that goes to increase the owner's basis in the property. Now, why is it important down here in Florida? There's probably more people that are currently snowbirds than there are people that are homeowners, and this is their homestead down here. And it's important because when they ultimately go to sell their unit, that basis increase is going to go to reduce their gain because they're not going to be able to take that exclusion that they can on their principal residence. So that's kind of where it is in terms of the budget, and you should just be aware of that. Cooperatives, as a last point, really have to watch, because in the event that you collect revenues in excess of your expenses, you're going to be subject to tax even on that revenue that you've collected in your monthly assessments. Whereas if you're a homeowners association or a condominium, there's a favorable taxing regime under 528 that says, hey, you can collect whatever revenues you want. If you collect 100, your expenses are only 50. Normally, if you were a regular corporation, you'd pay the tax on that $50. Not necessarily the case when you file under 528 and you file Form 1120H. So with that, I'm going to turn it back to Nicole.
I think we're good on the reserve side. I mean, on the budget side.
Great. Thanks, Nicole and Bill.
Thank
And I'm
you.
going to add a little comment as it relates to the reserves issue, because there is an additional bill, Senate Bill 1490, which I didn't bring up because it doesn't appear as if this will achieve passage. But it's interesting in that it allows condominium associations, through a vote of the owners, to invest reserve account monies with an investment advisor. And as long as there's an adopted written investment policy annually to do so. Most community association practitioners, including yours truly, thinks this is not a terrific idea, that reserve accounts should not be invested in whatever particular vehicle the local investment advisor may suggest. The monies probably should be just set aside in a very safe account for usage of those important projects down the road, and not be subject to the ups and downs of a stock market or whatever investment idea the investment advisor is suggesting. But
All right,
that's,
But it's interesting that they're bringing that up, because we got a call last week or 2 weeks ago, and they're investing their reserve money in Bitcoin. And
that's a terrible idea.
terrible, scary. And they say there's nowhere in the statutes that says they can't. And that's scary from an audit perspective and a risk perspective.
It'll be a gross violation, breach of the board members' fiduciary obligations if somehow that money was lost. That's one of the rare exceptions, perhaps, where a board member or board members who make that decision, and possibly a property manager that facilitates it, they could be exposed to personal liability for that type of decision making.
Yeah,
and it flies in the face of the FDIC rules that they put down for the associations, because there's no limit there going to invest. They could invest basically everything. And we've seen a number of associations that, think that they're really doing well because they've got unrealized gains because the market happens to be great at that point in time. But as you said, that could be, up in smoke fairly easily.
Exactly. Rudy, did you have a question or a comment?
I do. Making a note right here. Don't invest reserves in Bitcoin. Okay. There are some questions about some of the bills that you in the legislation that you talked about. This is recorded. A link will be set out. You'll be able to watch this whole seminar on YouTube. So for those that are coming in late, you can reference that. Also, there's some random questions like, what's the current minimum standard FICO score used in approving a prospective buyer for most condominiums? Is there an approved minimum FICO score?
There's not a statutory minimum. So it's whatever is reasonable. That's the standard. And my suggestion and what I tell my condominium association, rarely does an HOA have an approval process. Sometimes they do. If they do, I would say nothing more than 650. And perhaps even 600 is better to play it safe. But 650 is probably the max. I've seen some boards try and inch that towards 700, even 720, and I believe that to be too high and unreasonable, and could subject an association to a challenge if they deny an application based upon too low a credit score. Now, with tenancies, that's a whole different ball game in the sense that Housing and Urban Development have come out with advisory opinions indicating that credit scores should not be used at all as it relates to approving or disapproving of a tenant. And I know that is a common practice in many associations, and I understand there's some logic behind it, but I'll tell you what Housing and Urban Development's position is, that a tenant doesn't have any contractual connection from a financial perspective with the association, either condominium or homeowner association, and that the tenant pays the landlord rent. The landlord, in turn, pays the assessment, owes monies to the association in terms of monthly or quarterly assessments. So even if the tenant had a poor financial history, doesn't pay the rent, that does not obviate the landlord's obligation to pay the assessments to the association. Thus, Housing and Urban Development have opined that there's not enough strong enough nexus between the financial history and health of a tenant and the concerns and interests of the association to deny a tenant application on credit score grounds, which also is tied to the potential for a discriminatory action based upon someone's socioeconomic status, which becomes a possible Fair Housing Act violation and could give rise to litigation. So I'm currently counseling my associations on tenant applications not to use a FICO credit score threshold at all. You could still, of course, and should require that to be a criminal background check on your tenants. However, important aspect of the criminal background review, someone that had a marijuana possession arrest 14 years ago is not sufficient. That's not sufficient information or sufficient criminal background to deny an application. Housing and Urban Development, again, which is basing their opinions and their conclusions on the Fair Housing Act, states that only actual convictions, not arrests, not no contests, convictions of a crime where there is some level of violence or some other crime, a conviction of a crime to suggest that this individual could be a threat to persons or property within the community. So it's a pretty narrow scope in terms of being able to deny a tenant. I'm not saying it's not possible, but the denial of a tenant, if the association, the board, you as a property manager are looking to go in that direction, you probably should confer with the attorney to make sure you are acting in conformance with existing Florida and federal law. There's a Florida version of the Fair Housing Act. There's also a federal version, and multiple lawsuits I've seen that have been filed for denials on improper grounds. So bear that in mind.
Hey, Scott, we had something interesting come up about a week or so ago. We had a condominium in downtown West Palm here ask us about a situation that they had where there's quite a few buyers lined up to buy, and obviously the cash buyers are getting in first. But the issue that they had is that the folks that were in line to submit their mortgage applications were unable to submit them because they weren't going to be accepted because the condo itself was a plaintiff in a lawsuit. And, I think that they were looking to potentially maybe move that out into a separate entity just so that they could answer the questionnaire, I guess, from these mortgage applications to be able to begin to process them again.
Yeah.
Have you
I mean,
seen or heard anything on that?
yes, and I've had to deal with that issue on several occasions on behalf of associations that are involved in miscellaneous actions, in most cases involving a vendor who claims they were not paid when they were terminated for cause in the board of directors' opinion, and litigation ensues over the balance of the contract allegedly due to the vendor. And I've gotten that exact inquiry from mortgage brokers and mortgage bankers saying, what's the status of this lawsuit? Because it's interfering with our ability, to underwrite a loan or provide an approval. And bottom line, what I advise the association is we have to be honest, right? We can't say that the lawsuit doesn't exist or underestimate, what the potential liability may be. And these types of actions, it's really impossible to predict, although I could give an estimate in my own head to my board of directors as to the likelihood of a judgment being entered. I would never make a representation to a lender, say, yeah, there's a lawsuit filed, but there's virtual certainty that the case is going to be dismissed and there's not going to be any liability. Because if the reverse happens, and strange things happen in courtrooms all day long, and somehow the lender feels that they're in a less desirable lien position with their mortgage because the association just got hit with $1 million judgment, guess who they're going to look to? They're going to look to the individual, whether it's the attorney, the CPA, the property manager, who made an inaccurate prediction as to the potential liability associated with that litigation. So the litigation exists, you reveal it, you could describe it in general, but we don't make any predictions as to the potential monetary exposure of the association. And if that turns out, if it turns out that the lender, the bank decides not to fund the loan, the association does not incur or face or be exposed to any liability from the owner or the prospective purchaser who couldn't get that mortgage. So that's how we handle that situation.
Thanks.
Okay. We're starting to run short on time, so we're going to try and hit a few more things here that I deem to be pretty important. Same with Nicole and Bill. So adoption of rules and regulations. We love those. Why? Because those are board promulgated. We don't have to get a membership vote, and they could accomplish a whole basket of things when you adopt rules and regulations. Very important, relatively new law as of July 1st, 2018, that many associations are still not following. If you are adopting or amending rules and regulations, in order for those rules and regulations to be effective, they must be recorded in the public records. So proper adoption at a board meeting with a proper vote by the board members, recorded in meeting minutes, that's not all that needs to be done. Those rules need to be turned over to the attorney for recordation in the public records. Those rules are only enforceable once those rules are recorded. So bear that in mind. Rules are terrific, like I was saying, because they only need to be board promulgated, but there are certain caveats. We can't just create rules and regulations that go against and contradict or inconsistent with how the declaration reads. I view the declaration as kind of like the constitution for your community, condo or HOA or co-op. Co-op has bylaws, it's different, but POA. So you have your declaration, you have bylaws, which are procedural in nature. And sometimes I hear a mismentioning of the bylaws as kind of the declaration. Your bylaws are just deal with the procedural niceties of how the board of directors generally is to function, the makeup, notice requirements, that type of thing. But your declaration contains the heavy stuff, the substantive stuff that talks about maintenance obligations of owners, collection of assessments, how special assessments are to be imposed. Do you need a membership vote, or is it board of directors vote alone? So the declaration kind of rules the day. Rules and regulations are wonderful, but they cannot contradict what already exists in your declaration or your bylaws. If so, those rules and regulations will be deemed invalid and unenforceable. Rules and regulations are there to kind of fill in the gaps, to add to what already is stated in the declaration, but in some more detail. For instance, times that the pool happens to be open, or certain parking rules, or issues pertaining to golf carts. That type of thing belongs in rules and regulations, and it's useful for that purpose. And the rules still must be reasonable, and they must serve a legitimate purpose. So a rule, even if not inconsistent with the declaration, if it's wildly inappropriate and deemed unreasonable, then it won't be effective and it won't be enforceable. Adoption of rules also requires and mandates that there be a 14-day notice sent to the community, and accompanying that notice must be a copy of the rules and regulations, which makes sense. If you're putting the membership on notice that, hey, in 14 days or so, the board's going to consider the following rules and regulations, you probably need to give them a copy of the rules that are up before the board for consideration and vote. So remember, the notice at least 14 days out with a copy of the proposed rules to be adopted at that meeting. Adoption of amendments to declaration, that absolutely requires either a formal membership meeting or in certain rare cases, depending upon how your government documents read, can be adopted by written consent of the members. So the attorney for the association, of course, has to lay out the procedure as to whether it's a written consent, that's all that's necessary, or a formal meeting of the members. And when I say meeting, it doesn't mean we have to be present. This day and age, meetings, which is actually one of the components of one of the laws that I referenced, allows for meetings to go on just like we're doing today via Zoom, telephone conference, any type of virtual setting. So this complies with the notice the meeting requirement for that type of process, adoption of amendments. Okay.
So rules must be recorded even if condo docs don't require it?
Yes, absolutely. That's a statutory requirement. The process, and this is more of a practice tip as opposed to a law, in terms of the adoption of amendments, involves the following. I tell my communities, the board members that I represent, make a wish list, make a bullet point wish list of what you're looking to see incorporated into the declaration as an amendment. Then I take a look at that bullet point list. Sometimes those items are already covered in the declaration and we need not adopt an amendment for that purpose. So I do that. Plus I make my own suggestions, particularly if the documents are kind of antiquated, which many of them are. We want to bring it up to date, make it conform with Florida law in 2021, make some suggestions as to some good ideas from a practice, a governance perspective of the association. And then we combine our two bullet point lists, the one I create, the one the board creates. And then we have the board adopt the bullet point list at a formal board of directors meeting, which then commissions me to draft the legalese in the form of a proposed amendment, which then must be the subject of either a membership meeting or a written consent process for vote by the membership. For most condominium associations or homeowner associations, it's a 2/3 membership-wide vote that is necessary to approve that particular amendment, but is subject to what particular percentage exists in the governing document. So that has to be reviewed by your council to tell you what you need to get over that threshold in order to get an amendment adopted. And one little trick of the trade is we collect limited proxies in advance. You guys, I'm sure, are familiar with limited proxies, voting in favor of the amendment, and we bank them. So say we have this meeting scheduled and we have 51% of the members agreeing to the amendment by way of limited proxy, but we're not quite at that 67% number that we need. So at the meeting for the membership-wide vote on the amendment, we adjourn the meeting. We don't go forward. You don't proceed. You adjourn the meeting to a later date, and we reschedule the meeting with the idea of acquiring further limited proxies in favor of the proposed amendment, because the limited proxies are good for a period of 90 days. So we can, in some cases, I've had up to 4 meetings within that 90-day period, and we've collected limited proxies all along the way. Once we get over that 67% number, if that's the 2/3 threshold requirement for your community, then we have that membership meeting and we're good, and we've accomplished our task. So the limited proxy gives you that flexibility because it has a lifespan of 90 days, and you could have multiple meetings during that 90-day period to accumulate the necessary votes. I had mentioned also about the lifespan of some of the documents of your communities that may be a bit antiquated. And this is, the people the managers that are on this call who represent a condominium association, you could take a 3-minute nap because this doesn't pertain to you. It's just homeowners associations. There's something called the Marketable Record Title Act, a very obscure law under Chapter 712, which calls for, and I'm going to summarize in a very general nature, there are a lot of nuances to it, but if your governing documents, again, just for homeowners associations, are more than 30 years old, guess what? They no longer exist. They are invalid, unenforceable, and expired. What does that mean in a practical sense? That means you as a homeowner association and you as a property manager on behalf of your HOA cannot really collect assessments because the ability and right to collect assessments against your owners derives from the language in your governing documents. And if your governing documents have expired, guess what? You've lost the ability to charge and collect assessments. You've lost the ability to do covenant enforcement. Violations, no longer able to go through that process. Because again, the declaration is the document that contains the provision that has covenant enforcement like rights and obligations, etc. So what do we have to do to avoid that from happening? Before we hit that 30-year mark, there's a really simple procedure to avoid this catastrophe in a homeowners association context. That's through the recordation of something called a notice of preservation, which is typically a 2-page document that springs back to life and gives our declaration and for homeowner associations another 30 years to live and breathe. It's really simple. It's easy to do. The attorney has to prepare it, but all it requires is a board vote. Again, way simpler than a membership vote. What happens if we forget? We didn't realize we've gone past the 30-year mark. We've never done the 30-year notice of preservation. Well, we're in land of expiration. Now, there's a way to breathe life back into the documents through something called the revitalization procedure. Way more involved, way more expensive. When I say way, I'm talking about probably 50-fold more expensive, and it requires membership acquiescence, whereby at least 51% of the members have to agree to revitalize your governing documents for homeowners associations. A whole set of documents have to be sent out to the membership, copies of all the governing documents that exist from day one, acquiring a certain written form from the members, 51%. Once that's all in hand, and it all has to be done within 90 days of a strict timeline, 90 days of the initial mail out for that purpose, then it will be sent to the Department of Economic Opportunity in Tallahassee for approval. Very involved process. I've gone through it a few times for a few communities that came to me after the 30-year mark, and we were able to do it successfully, but it's cumbersome and expensive. So let's not let that happen, and have me or your counsel review your documents to make sure you've already been preserved, or if you have not been and you're within the 30-year mark, we shoot out that quick notice of preservation and record in the public records. Why this doesn't apply to condominium associations? We probably don't have the time to go into it, but the quick synopsis is, with every deed involving a condominium association unit, there is a reference in virtually all cases to the condominium declaration and where it's been recorded in the public records. Because there's a specific reference in those deeds to the existing declaration, each and every time a unit is sold under the Marketable Record Title Act, that reference causes the springing back to life of the declaration. So virtually never is a declaration of condominium subject to this Marketable Record Title Act 30-year expiration, only in the 30-year, only with HOAs. Okey-doke. Collection procedures, and then I'm going to shoot it back over to Nicole and Bill. So again, I want to try not to be too simplistic, but you guys as property managers are pretty familiar with this, but some of these things are worth noting. I break the collection procedures kind of into 3 steps. After the property manager, you guys have sent out your initial reminder letter to the owners that they're late. That letter, in fact, it's mandatory pursuant to that new law. And once that is done, and if the owner still hasn't properly responded and paid what they owe, it gets turned over to the attorney for purposes of us sending out the demand letter, the initial collection letter, or sometimes also called the notice of intent to lien letter. So that goes out, and a condominium association contacts 30 days later. If the owner still has not paid, a lien can be filed against the property. For HOAs, it's 45 days. So step 2 is actually the filing of the lien against the unit. And that lien goes to the unit owners, and hopefully that shakes them up enough to just stroke a check and pay the bill and get their account current. If they still don't feel compelled to pay what they owe, then the next step would be the filing of a lien foreclosure action, just like a mortgage foreclosure case. It's a lien foreclosure case. It's the foreclosure of the lien on the home. For condos, it's 30 days after the claim lien is sent out, and for HOAs, it's 45 days. Now, in between step 2 and step 3, there should be a pause, a discussion, and a deep analysis with your attorney as to whether or not it's appropriate, whether or not it's a good business decision to file a lien against this particular individual. And the factors at play involve, hey, is there a mortgage foreclosure that's already pending on that same unit? Because the bank's mortgage foreclosure will take priority over and supersede what we could do in a lien foreclosure. So there's no sense spending a bunch of money in a lien foreclosure case if a bank is already bearing down on that same owner and likely to take ownership of that property through foreclosure on their end. So that has to be looked at. Also, the condition of the property, because if the association is going to end up with this property and the property is filled with mold, whether it's a condo unit or a home that's just not been taken care of, that asset will become the association's problem. So we want to have some idea, if we're able, to understand the condition of the property before we become the owner of the property. And that's typically what occurs at the tail end of these lien foreclosure cases. The association becomes the owner. That takes place if the owner still doesn't pay along the way. Now, the filing of the case in many instances finally seems to grab most owners' attention when they get a knock at the door from a process server saying you're served with a lawsuit. Oftentimes the owner, if they haven't paid attention to the filing of the claim of lien or the demand letter, they wake up at that moment and realize, okay, the time is up. I need to start paying because I have a lawsuit I now have to deal with. And that balance absolutely incorporates all attorney's fees and costs incurred as involving the filing of lawsuit, process server fees, attorney's fees, clerk of court filing fees, etc. So the association would be absolutely made whole in that instance, in that situation. What happens if there is a mortgage foreclosure and the bank takes title to the property? Happens a lot, not as much today, but I'm sure you guys have experienced that along your travels as property manager. Well, the bank at that very moment, becoming owner of the property at the very end of the foreclosure process, occurs by virtue of the issuance of a certificate of title by the court. And once that occurs, that triggers the bank to do two things. They would owe something called the safe harbor payment. Safe harbor is equal to 1 year's worth of assessments due on that unit, or 1% of the principal balance of the original mortgage. Here's the unfortunate language, whichever is less. So out of those two numbers, whichever is less, the bank owes that as a one-time infusion of money to the association as a result of being the winning party at the tail end of a mortgage foreclosure. The second thing that also takes place is the bank becomes responsible and liable for all assessments going forward from the moment that that certificate of title is issued in its name. So it's not a disaster for associations, but at least there's some payment to the association for back assessments. Oftentimes it leaves the association shortchanged if there's a seriously delinquent account in a mortgage foreclosure context. But that's something to bear in mind, and why it's important that the mortgage foreclosures be monitored typically by counsel. So these types of safe harbor demand letters are sent out. Let me give you a little quick nuance, and I know I'm running out of time, and I really want Michelle and Bill to pick up on the last topic. What happens if a third party buys the property at a mortgage foreclosure sale? banks, take the litigation all the way to the tail end as a foreclosure sale. More times than not, the bank is the high bidder, just because the bank has an automatic bid equal to the amount that they're owed as set forth in a final judgment. Sometimes the property actually is worth more than what the bank is owed. That's more true today than, say, 10 years ago, certainly. And if that were to take place, you'd have third parties perhaps interested in bidding for this property. If that third party is the high bidder, bids above what the bank is owed, and the third party is awarded the property, as long as your governing documents don't say otherwise, that third party owes the association all past due assessments for the past 5 years, which is a very nice payment to the association in a situation of a seriously delinquent account. However, the language in your declaration, whether HOA or condo, will dictate whether you could demand that 5 years worth of assessments, because some governing documents will say something like any and all purchasers at a foreclosure sale, as well as a financial institution, their liability is limited to just the assessments going forward prospectively after they take title to the property. If we have language like that, my recommendation is we're going to do an amendment to documents, make that one of the line items to increase the chances of a larger payment coming to the association in the context of a mortgage foreclosure sale with there's a third party that wins the bid. In a lien foreclosure sale, if someone bids above what the association is owed, terrific. And then that third party has paid more than what the association is owed as set forth in the final judgment. That gets deposited into the clerk of court registry. That money goes to the association to pay the entire amount that the association is owed. And it's a fantastic result. And now we have a new owner who owns this property that owes the assessments going forward as that new owner. So that's what we have as it relates to foreclosures and both lien foreclosure and mortgage foreclosure. As involving delinquencies, and we just have a few minutes left, I'm going to let Nicole and Bill talk about the application or accounting procedures of monies received on a delinquent account.
Bill, you want to take that today? I'll let you have that one. Since it's the end of I've taken most of the talking today. I didn't want to.
Yeah, that's a good happening for an association to actually receive those delinquent funds. And typically what would happen is it would go on the accounting side to wipe off the receivable that was on their books associated with that, correct, Nicole? And they'd have the ensuing cash as well. And on the tax side of it, we would need to take a look at it to see what the payment was in terms of what was in arrears and what might be taxable.
Correct. And you should already have in your financial statements an allowance for bad debt for those prior years that you've been carrying on the books. And then once it is resolved, it would be written off.
Yeah. And just one other fact on that, we get a question quite often on there, if they've been carrying a receivable balance on the books for a long duration, why don't they just write it off? And typically what we recommend is that they keep it on the books so that it's known that there's still a lien against that and a debt that's still owed.
Right. We don't advise them to write anything off until they have been advised by the attorney if it should be written off the books.
Right.
And there's a unique opportunity in the context of tax deed sales and mortgage foreclosure sales in terms of surplus proceeds. Like I was mentioning, today's real estate environment, you're seeing more and more people bid at these sales, when there's delinquent property taxes, there's a tax deed sale or a mortgage foreclosure sale, which results in excess proceeds. Now, the first amount of money, the first tranche of money is used to pay off the judgment, whether it's owed to the bank or owed to the tax collector in the tax deed sale context. That excess money, called surplus, that's available for associations to make a claim on those surplus proceeds, which could be used to offset the delinquency on an account. Now, the strict timelines for filing it's called a statement of claim, both for tax deed sales and mortgage foreclosure sales. Filing that statement of claim with the clerk of court, getting it in on time, and in some cases requires some type of litigation to have the court release those monies to the association, to the attorney for the association as a lien holder. And it's sometimes a battle between lien holders in terms of priority of disbursement of these proceeds, but we've collected tens and tens of thousands of dollars for several communities as it relates to these surplus proceeds, both in a tax deed sale context and for mortgage foreclosure sales. So if you get a notice as it relates to that, these tax deed sales and mortgage foreclosure sales should be monitored to see what the actual sales receipts are with the clerk and see if it exceeds the final judgment. So timely statements of claim could be filed by your association, which could be used to offset, like I was saying, those delinquencies on that account, which I'm going to shoot real quick back to Nicole and Bill to wrap up. Say, what happens if we get these surplus proceeds in that context? Would that be income, or could that just be applied to the delinquency that exists on the account involving the property, which is the subject of that foreclosure sale or tax deed sale?
Well, from the book standpoint, Bill, from the tax standpoint, it's probably different. From the book standpoint, if it is a surplus and it's over what they anticipated receiving, it would come in as other income. I don't know from the tax side, Bill, if it would be taxable.
It most likely would be because it's coming from a third party, not from an owner. So, yeah.
Okay.
And we'd have to go back and see if there was any basis against that in terms of unpaid amounts on the association's books
Right.
to compare against.
Well, thanks. Perfect. So we tried to squeeze in as much information in this 2-hour time span as possible. And as it always happens, and this is, I don't know, the 6th or 7th time we've all done this, I never get to everything. So if I didn't hit something that you wanted me to talk about, please email me. I'm happy to field your inquiries, Scott, SCOTT, at sjwlawgroup.com, or my phone number, 340-4555. And that's all I have. So I appreciate it. I'll turn it back over to Rudy and Peggy.
Everybody, just some housekeeping. We give us about 30 days for the continuing education. Scott's going to have to file those. It's been taking a little bit longer for those to kind of get credited because of COVID and because of processing. So bear with us. Hopefully you gave the proper CAM number and the proper name and all that matches. Wait about 30 days. If you don't hear anything, please reach out to Scott. We will be posting a link. Everyone's going to send a follow-up email with kind of their scope and breadth of services. And in that email, we will provide a link, and please reach out to us for any questions. Thank you once again for attending. It was a great class. I know I learned a lot, and I'll turn it over to Peggy to close us out. Peggy, you're on mute. You're on mute. Peggy, you're on mute.
Peggy, you're on mute.
Rudy, why don't you close it out?
Okay, there you go. No, I just want to thank you, Scott. That's awesome information for your accredited class today. All the property managers, like Rudy said, are going to be getting credit, and we look forward to more classes. I want to thank the audience for coming on today. I will be sending out a sponsor sheet, which will have all the contact information of all of our sponsors today, so that you guys can reach out for any other opportunities that you may need some help and assistance on. I also want to thank Vinteum Software again, especially Yasmin and Layla for the wind beneath our wings here to have this go through successfully. And Frank, welcome, and for your presentation. I also want to thank Rudy Martin. Thank you so much for taking the moderator position, and all my sponsors again. So I look forward to seeing everyone in the upcoming May and June classes, and reach out to any of us when you get your sponsor sheet. Have a great afternoon, everyone.
Thanks, everybody. Have a
Thank
great
you.
day.
You as well.
Thank
Thank
you.
you.
Great
Bye.
job, Scott. Thank you. Bye, guys.
Thanks. Take care, guys.